I'm Caroline Hyde, in for Emily Chang in New York. This is Bloomberg Technology. Coming up in the next hour, closing in on a deal. T-Mobile on the cusp of securing approval from the U.S. Justice Department for a $26.5 billion merger with Sprint. Will this merger advance the introduction of 5G? Plus, a Bloomberg scoop, Broadcom seeking to further expand into the more profitable software business with a possible Symantec acquisition. We have the details. And what a first half for tech IPOs. Nasdaq announcing its welcome 97 initial public offerings, raising over $17 billion in just 6 months. Can it be sustained? We ask a Nasdaq exec. But first to our lead, and another turn in the T-Mobile Sprint deal. The U.S. Justice Department is reportedly on the verge of approving the merger. Among the terms being hammered out, it's the sale of assets to Dish Network that could ensure that Dish actually becomes a strong fourth competitor in the U.S. wireless market. For more, let's bring in Bloomberg Deals reporter Nabila Ahmed. You broke it. Congratulations. And how close actually are we? It's been a long time coming.
It has, Caroline. This is a very happy turn of events for investors. You're seeing shares pop up today. They're getting very close. They're nutting out the final details. We're being told that there are a couple of issues remaining, but they're not insurmountable. Our sources are saying that actually the board of Deutsche Telekom, which owns T-Mobile, met yesterday to discuss this package that is being discussed with the DOJ. And these are the remedies that will help the DOJ approve the deal.
And remind us what the remedies are. What are they selling to Dish?
So the main things they're selling to Dish are their 3 prepaid brands. There's going to be some spectrum as well, and they're providing some operational support to help Dish get the customers across to their network, and then also there's going to be some arrangement whereby they share the network and spectrum.
So this is what regulators have been grappling with, worrying about, is the fact that suddenly you bring 4 players down to 3. So this sort of alleviates that element. But it's not just the Department of Justice that has perhaps had issue with this. It's not just regulators, it's the states themselves. Some of them have filed lawsuits, haven't they?
Exactly. So we've got 13 states and the District of Columbia who have come out against this deal. They're worried that it's going to be bad for consumers. It's going to raise prices. You're taking away one of the players from the market that's, at face value, never a good thing for consumers. But if the DOJ and the FCC both approve this deal, that makes the state's case a lot weaker, because they then have to argue to the court why they're not going along with these governing bodies whose job it is to assess competition and consumer protection.
We wait with bated breath. Nabila Ahmed, I'm sure, will be there to break the final hurdles of this deal. Now let's talk about a Bloomberg scoop, another one, because on Wednesday, shares of Symantec soared after Bloomberg learned that Broadcom is in advanced talks to buy the cybersecurity firm. At Tuesday's close, Symantec had a market value of about $13.7 billion. For Broadcom, well, a deal would mean a further expansion into the more profitable software business. Piper Jaffray analyst Harsh Kumar wrote that Symantec would make a perfect fit for Broadcom portfolio. He joins us now from Memphis, along with Liana Baker of Bloomberg Deals team, who was helping on this story. I want to first go out to you, Harsh, because talk to us about why this is a perfect fit.
Thank you for having me on the show. I think Symantec at the initial stage passes the smell test for Broadcom. Broadcom has 52% operating margins, so for them to consider an acquisition, it has to be immensely profitable. There just aren't a lot of companies that can reach or have the potential to reach 60% plus, I would say, would be the threshold or hurdle rate for them to look at an acquisition. The last deal that they did, which was Computer Associates CA, actually is performing extremely well. And when we look at something like Symantec, it has shades that are very similar to CA in terms of the two businesses, one already at 50% operating margin and with a little tweaking could potentially get to 60%, and the other that they could just drop into the CA platform and absolutely strip it of cost, mostly marketing and sales costs, to drive operating margins further. So from that angle, it would be an immensely profitable deal, and it would be an extension of the portfolio that they have with CA.
Yeah, interesting, Liana, because we've been waiting for years, really, to work out what they would go after CA and indeed after the Qualcomm deal fell away. What makes Symantec sort of all the more vulnerable, so to speak, to being bought out at the moment?
There's been a lot of drama at Symantec. As we've been following, their CEO, Greg Clark, had been ousted a few months ago. There had been an accounting investigation, and then Starboard Value, an activist investor, came on the scene and was pressuring the company, and they got a few board seats. So it really is a vulnerable time for Symantec for a takeover.
Liana, we were just talking about the T-Mobile Sprint deal and the regulatory issues at that. Are there going to be CFIUS or regulatory issues with this particular deal, considering Broadcom in the past wasn't able to get through the Qualcomm deal?
Before Broadcom went after Qualcomm, they had a Singapore headquarters. They've now moved totally to the U.S., so they're trying to alleviate that issue. But cybersecurity is of national security concern, and Symantec does do work for the U.S. government. So the CFIUS review is definitely something investors will be watching to see how it goes. There could also be an EU review. So no slam dunk for any large deal where there is this national security element.
Harsh, putting regulatory concerns to one side, you really have spelled out why you think this might be a perfect fit, why it might be accretive to the business. Interestingly, other analysts, investors are perhaps questioning management strategic direction here. Do you think it's the right direction to be going more focused into cybersecurity? We've seen other players do it, but how does it really fit with broadening outside of the chip space?
So I think Broadcom is focused singularly on capital returns to the shareholders, driving free cash flow, driving profitability. Understand this is a company that was at the cusp of 50% operating margin, a region that no other company in the past had been able to approach in the semiconductor land. With the CA deal, they were able to push that envelope closer to 53% in the last quarter, now running about 52%. So really for them to be able to expand and build on that, they need something outside of hardware, something outside of semiconductors. Typically, software companies tend to have extremely high gross margins, and they tend to spend a lot of money acquiring new clients. The strategy with CA revolved around what I would call as dig deep and all-you-can-eat strategy, which is dig deeper into existing clients. Don't worry about getting new clients. For example, in CA's case, there was roughly about $1 billion spent on acquisition of new clients per year, so that cost went away. With Symantec, it would be easy to go back to the same clients with a bigger portfolio and thus drive profitability. That's why we think it's a perfect fit.
Interesting. And we've seen the shares pop of Symantec today, closing about 14% higher, Harsh. What sort of premium do you envisage? Because this is a company, as Liana had been spelling out, under some duress to a certain extent. Do you think there could be any sort of bidding war? Do you think this could go higher?
I think it's certainly possible that other people could come in. I'm not an expert on M&A or by any means investment banking aspects of the deal, but we think certainly a little bit premium from current prices would still work as far as Broadcom's ability to take it and generate the kind of returns, particularly given the success they've had with software in the past.
And Liana, interestingly, both these companies have a sort of private equity background and history. Will PE be in any way involved in this?
Symantec's board has some private equity representatives from Bain and Silver Lake, so they will definitely have to be involved somehow. They're major shareholders in the company. Broadcom was also built up through private equity routes. Originally, they had worked with Silver Lake and some other firms, so private equity does weigh heavy here, but at this point, we don't know exactly the structure of the deal and how they'll participate.
We'll wait for you to break that next. Liana Baker and your entire team is a great scoop. Meanwhile, Harsh Kumar of Piper Jaffray, analyst, we thank you very much for bringing us your insights. Now, coming up, the EU continues to crack down on US tech companies due to antitrust issues. This time, it's going after Facebook. We bring you the latest next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. So Facebook is the latest tech company to come under the EU antitrust scrutiny. The European Commission has reportedly sent questionnaires to Facebook's customers and competitors about a range of practices as it seeks to determine whether the social network uses its size to squeeze out competition. Officials are also looking at Facebook's sales platform and, well, how it uses and shares data from apps. Companies have been asked to respond by next week. Now, the EU is also looking at how Amazon collects data from retailers through its platform, and of course, it's previously fined Google for anti-competitive behavior. To discuss, I'm pleased to say we're joined by Techonomy founder David Kirkpatrick and Max Chafkin of Bloomberg Business Week joining us from San Francisco. And Max, I'm going to start with you because does Facebook have something to worry about here? Have companies, competitors voiced this as a concern in terms of their size and squeezing them?
So at the end of last year, there were some internal emails from inside of Facebook and its executive team that were made public that were read by some to sort of imply that Facebook was cutting rivals out of its platform. Other social networks such as Vine, which was the Twitter-owned video network, which, you know, it kind of reminds you of some of the allegations that were levied against Microsoft in the late 90s, where the sort of allegation was Microsoft had this dominant platform, Internet Explorer, and that it was sort of forcing it onto people's computers. So I don't know, it's certainly a problem, and it plays into a larger narrative that's happening around the world about Facebook and maybe tech power more generally.
A larger narrative, David, that you know about only too well. But interestingly, we have heard Facebook particularly sort of saying bring on the regulation to a certain extent. Their tactic has been to go out and say, look, GDPR that the EU brought in has been a pretty good way of means of regulating us. How will they look and respond to this sort of anti-competitive regulation?
Mark may say he wants regulation, but he doesn't want antitrust regulation. He wants help with speech, controls and that sort of thing. Privacy advice from the EU has been, he claims, beneficial. But, I think the kind of thing you were talking about with Max and this new investigation is very potentially problematic for the company, partly because we've seen in so many instances that they really didn't have the controls or the internal behavior to get through these deeper scrutiny situations without malfeasance being discovered. So the chances that there might be something there is reasonable, but the other reason it's problematic is just that everybody uses Facebook for marketing. Any company, you can't not use it if you have a consumer product. It's pretty much necessary, and that includes digital products, many of which might be seen as competing with Facebook. So it's certainly easy to imagine that companies that Facebook perceives as potential competitors have used Facebook in order to advance their own cause, and Facebook had data about that it gets from operating the platform that they could quite possibly have used against potential competitors. And as Max said, in the case of Vine, there was reason to think from some Zuckerberg emails that had happened.
Max, you talked, of course, of the wider theme here, and interestingly, what's coming from Capitol Hill in particular is the call to split up these sorts of companies, particularly from 2020 presidential hopefuls such as Elizabeth Warren. Now, Margaret Vestager of the EU has previously said she doesn't think splitting up these sorts of companies is the right way forward. But what do you envisage? How do you think the EU will be debating the power of this company?
So it's hard to imagine splitting up Facebook because, the U.S. kind of had, and regulators around the world sort of had a crack at this when Facebook bought Instagram. And so it's a little bit strange to say, okay, well, we're going to turn back the clock and change things. I think it's more likely to be sort of regulations around data usage and sort of fair access to data, that sort of thing, or just big fat fines. And the thing about both of those sort of outcomes is neither of them necessarily hurts Facebook all that badly. It's such a dominant platform, as David said, that if regulators are just picking away at their business at the margin, it probably doesn't do that much damage to them.
Yeah, what does a $5 billion fine get you when this is a company that brings in billions per quarter? David, your perspective on how Facebook continues to evolve and take on this sort of regulatory scrutiny, are they thus far starting to handle it in the right way?
I think they've made enormous progress in the way they talk about the challenges they face. I was in Aspen last week and I heard Zuckerberg give a interview that was more contrite than some and one in which he does acknowledge a lot of things that they are doing differently and that they need to do differently than they have in the past. I often wonder why they let things get so out of control in the past, but certainly they're moving slowly in the right direction, but they have some structural problems that are going to make it really hard. I mean, the very nature of their ad model and the way it demands our attention and the way we're targeted, it does tend to encourage the use of content that's very incendiary, and they're going to constantly be fighting against that particular problem.
What about, Max? Also, of course, regulators have been very focused on the announcement of the so-called cryptocurrency, Libra, even though it's not due until sometime point 2020. And do we foresee the regulatory narrative just continuing, and in you seeing, as a journalist overseeing this, a way in which the company can navigate this successfully, remaining in a whole in all its forms?
I mean, I think the real risk to Facebook is less regulatory and more about brand risk. I mean, people forget because, it's sort of been the subject of so many negative headlines over the last couple of years, but Facebook has a wonderful brand. I mean, most people really like it. I mean, it's got this amazing founder story. Mark Zuckerberg, for all the criticism, is, I think, still a, relatively admired, popular guy. And I think the risk for them is that, you go through a couple of years of this, or 3 or 4 years, and it turns into this steady drumbeat of negative criticism, and people, around the world stop seeing Facebook really as their friend. And in the long run, that will hurt the company because they will lose users. And it should be said that to date, that hasn't happened yet. But I think if I were sitting in their shoes, that'd be the thing I'd be most worried about.
Yeah, David, how do they tackle?
Well, I would disagree a little bit with Max, because I think among educated users in the US and Europe, that has happened. A lot of people have really been affected by the endless coverage of Facebook mistakes and really serious problems that we've heard in the last couple of years, particularly since the election of Donald Trump. In the real key markets where they're growing around the world, developing countries, India, South Africa, Brazil, it isn't a factor really, and they're still really just raking in the money and the growth in those markets. The question of Libra is very interesting. I happen to think it's a very promising opportunity for them. And, we've heard about blockchain and Bitcoin for a while. It's only because a big company is finally doing something that sounds like it might work that people saying, oh, that is a threat to the global banking system, and maybe they'll be stopped. But I actually think this was one of the smartest things they've done.
We'll leave it at that. Economy founder David Kirkpatrick, always great to have you on the show.
Thanks.
We thank you. And Bloomberg's Max Chafkin, great insight from San Francisco. Now coming up, Tesla hitting a 2-month high in its share price, that after reporting record deliveries for the second quarter. How the street is assessing the outlook from here. This is Bloomberg. So Tesla has done it. It set a new record for quarterly vehicle deliveries. On Tuesday, Tesla announced it had handed over 95,000 vehicles to customers in the second quarter, beating the average analyst estimate of 88,000 units. This is all due to accelerated shipments to Europe and China and US consumers rushing to buy Model 3 sedans before the federal tax credit shrank in half. Now, CEO Elon Musk had told employees in an internal memo last week that the company was close to setting an all-time record, urging them to go all out in the last few days of June. Joining us now is Williams Trading senior analyst Brad Meikle. Only a $70 price target on this company. And from New York, Bloomberg's Craig Trudell. Craig, I'm going to start with you, because does this end the fears over the demand side of the equation then, or were there some seasonal factors at play here?
I think it puts a serious dent in the concerns about the Model 3 demand. There was definitely reason for people to sort of freak out about how much demand there was based on the first quarter numbers, which were really ugly. But you heard Musk sort of make some excuses about, seasonality or early part of the year is the worst time of year for car sales, which is true. And also there was, this issue of the tax incentives that you referred to. They actually also halved from December to January, so there was this sort of rush effect in the fourth quarter. So you had this big sort of payback first quarter. Obviously, they've really come back on the Model 3. With the Model S and Model X, though, I think there is still some cause for concern with those vehicles. They're getting older. They're much more expensive, and you're maybe seeing some cannibalization going on, and that's causing some concern about profitability.
Concern about profitability. And Brad, you've said every day the value of the brand is going down. You said that in the past. Do you still feel that when you see deliveries such as this?
Yeah, I do. Our research indicates that the quality and reliability issues have become a big problem. By the end of this year, Tesla will have 1 million cars on the road, and it's without a service network, it's difficult to support that. We've seen everything from paint issues to cars being sold with 1,000 miles on them and prior accidents. And I really think that they have a real challenge with the cannibalization. With the Model 3, you get most of what you got in the Model S for 60% less, and that's the inherent problem. I think that they missed the mark with the Model 3, and the company is going to keep burning cash unless the Model S and X demand rebounds. And recent quarters, it's been tracking to down 45, 48% year-on-year declines for those two models.
So what do you think, though, about the next generation of models that are set to come, the Y, the likes of the SUV? Is that not going to be enough?
I think the focus is wrong. I think that the focus should be on low-speed vehicles, or also called neighborhood electric vehicles, which are lower speed, all-electric cars, like the Moke, for example, which has a max speed of 25, 30 miles an hour, but it's a great neighborhood car. It's all electric, it's inexpensive, and if we want to offset our carbon footprint for transportation as a country, what we need to do is use local cars that are electric, that are more inexpensive. And 80% of the trips taken in the US are one person going less than 3 miles. So driving a Suburban on that trip is like taking a 747 from San Francisco to Monterey. It's just too much car, unnecessary.
Although people have always loved the luxury feel, the power of these cars, Craig, is it enough to ensure that their guidance holds up? Because it was interesting they didn't reiterate their guidance.
Yeah, that was something that a lot of the bears are sort of seizing on. You had this really sort of nightmarish first quarter deliveries number that they reported, and even still they said we stand by our 360,000 to 400,000 forecast for the year. They left out any reaffirmation of that from this release. Obviously, to get to that number, they would need to average about 100,000 units the next 2 quarters. That's going to be really challenging for them to do, and that would just get them to the low end of that guidance. So there's still sort of reason to be concerned about their ability to sort of stand by that forecast.
Now, Brad, even though you think perhaps overall Tesla should go down market, so to speak, more cheaper vehicles, I'm interested by what you take of the executive leadership at the moment, because as Craig has been reporting excellently, there's been yet more drip, drip, drip of people leaving. This time we understand the head of Europe and a key engineer is gone. Is this a worry? What do you think for the future of Elon Musk as CEO?
Yeah, there's been a ton of turnover at all levels within the company, and I think it's very alarming and brings questions to the overall continuity of the story. I think the investor messaging has changed a lot from 2012 when the company went public. It was all about the mainstream electric vehicle. Now the Model 3 is still a $48,000 average selling price car for the company, and it's far from the $35,000 level. And I think that the price, as it comes down, they're going to burn more cash.
Brad, we thank you for spending the time with us. Brad Meikle, of course, Williams Trading Senior Analyst, and Bloomberg's Craig Trudell. Coming up, we're going to be talking about Nasdaq's tech IPO wave so far this year and what it means for the momentum to continue. We speak with the Nasdaq executive. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in for Emily Chang. Now, Nasdaq announced today that in the first half of 2019, the exchange welcomed 97 initial public offerings, raising a total of $17.7 billion. Among the wave of IPOs that were welcomed on the Nasdaq so far this year, well, it's CrowdStrike, Lyft, Beyond Meat, Zoom Video. Joining us now in San Francisco is Nasdaq head of Western U.S. listings, Jeff Thomas. I mean, congratulations. It's a big haul. You claim to have won 88% of VC-backed deals. How do you hope to continue this sort of foray?
Sure. So it's been an incredible first half of the year. As you mentioned, we've had 97 new members join the NASDAQ family this year. We've got a great lineup looking out to the second half. We're just going to continue working with companies throughout all phases of their life cycle, from the earliest stages through NASDAQ Private Market, helping companies evaluate the right time to go public, and then providing great support to them throughout their lives as public company. And hopefully the markets will cooperate.
talk about the markets cooperating, because in some cases it felt like they didn't quite, particularly for the slightly older generation, whether it be Lyft that listed on Nasdaq and Uber that didn't. But how do you ensure that the investor base out there doesn't think these companies are waiting too long to come to the public markets?
Yeah, one of the major differences now and between 5 and 10 years ago is the amount of capital available in the private markets, which allows these companies to stay private so much longer, creates challenges for them around providing liquidity to their employees and their shareholders, and really making a judgment about when the public markets are right for them. And then, as you mentioned, companies that wait longer, obviously there's fewer gains for the new investors in the public markets. And so we're there to help companies evaluate that and supply the liquidity they need and make that decision.
How do you win Uber next time?
So there's a number of great iconic brands that are looking to come to market, and our playbook is really the same on all companies. It's support them as they are evaluating the public markets and really provide the best trading platform, the best investor relations solutions, and the best marketing and branding platform for all public companies.
Interestingly, some public companies perhaps have done badly from not an always intuitive manner. I'm thinking of Beyond Meat, which for me almost feels like it was completely mispriced. It is now up 500%. It jumped 167% on the first day of trading. What went wrong? Are the bankers not pricing these IPOs correctly, considering we get more and more that are popping more than 80% on the first day of trade?
Well, I think one thing that's clear is investors are willing to pay for future growth. So you've got companies that are out there, they have extremely high growth rates. However, many are still loss-making. And so investors are willing to bet on the fact that these companies are going to continue their growth rates and eventually turn to profitability. And as you try to gauge, how much forward growth investors are willing to pay for, that's definitely a delicate balance. And then there's also some great consumer brands out there like Beyond Meat, where they've got a heavy retail following, which of course drives a lot of interest in the name and frankly makes it a little bit tougher sometimes to gauge what that interest level is going to be.
Is there a way that Nasdaq can help with that?
Yeah, we actually have a whole team that's focused on helping companies to identify who are the likely buyers, not only in their IPO, but throughout their lives as public companies. And we help to provide that information to both prospects as well as listed companies through our investor relations services.
Why didn't it work with Beyond Meat?
Well, every story is different, and they had a great investment bank working on their IPO as well. And I think one thing that's clear is that companies that start out on an upward trend, it's a lot easier to continue that momentum than the opposite.
What's interesting is still many, even though we've had a phenomenal number of companies coming public through you, there's still fewer public companies than there used to be. Is this something that you think the tide will shift in some way? Are we starting to see more and more companies being tempted to come public? Will the balance be restored in some way?
Well, we think it's a super important question. You have over half of American households are invested in U.S. equities. So having a fewer number of public companies to invest in is a big challenge in terms of keeping America competitive, both on an income as well as a wealth equality front. That's why we launched our initiative 2 years ago called Project Revitalize to update some of the legacy regulations around going public to make it easier for companies to go public. But I still think one of the biggest drags on companies' motivations to go public is the amount of capital that's available to private companies. As long as there's access to capital and liquidity in the private markets, that's going to reduce companies' desires to access the public markets.
And given that we're expecting yet further liquidity to come in terms of the form of cheap money, central banks in easing form at the moment, whether it's in the US or indeed around the world, this pool of liquidity from private holders and searching for yield doesn't look like it's going anywhere anytime soon. So, Jeff, is that sort of status quo here to stay? When do you feel that might shift?
No, we think it is a structural shift, and that's why we launched Nasdaq Private Market 5 years ago. We've now completed over 250 private market transactions representing $20 billion in liquidity, all through company-sponsored secondary liquidity programs. So we think it's a very important part of the life cycle as companies wait longer to go public to be able to recycle that capital, provide much needed liquidity to their employees and early investors to help them stay engaged for future growth.
So is it going to be 97 in the second half?
We usually benchmark a good year for us is around about 140. So we're well ahead of the pace, and we'd sure love to see a double in the second half. I think as we look at it, we're going to have some great IPOs come to market in July that have already filed publicly. There's always a little bit of a lull in August, And then we've got a nice early Labor Day and a nice late Thanksgiving this year. So you've got a nice long window between Labor Day and Thanksgiving for a lot of great companies to come to market. And then we'll see how many more we can sneak in December. But we sure would love to see a double in terms of the numbers we did in the first half.
Jeff Thomas, we thank you very much for making some time amid a busy playbook. Nasdaq head of Western US listings, we thank you. Now, coming up, more on the twists and turns of the T-Mobile Sprint merger and why it might finally be getting the okay from the DOJ. This is Bloomberg. Now, a number of US tech companies reportedly may shift substantial production out of China as a result of ongoing trade tensions. According to the Japanese news outlet Nikkei, HP and Dell plan to move as much as 30% of their notebook production away from China. Meanwhile, Microsoft, Amazon, Sony, Nintendo, they're also looking to move some of their game consoles and smart speaker manufacturing away from the country. Now, last year, Apple hinted that it might have to raise prices because of tariffs on products made in China. And as we mentioned earlier, T-Mobile is on the cusp of securing US Justice Department approval for its $26.5 billion merger with Sprint. This after establishing, well, the general outline of asset sales to Dish Network, according to people familiar. Now, the Justice Department is hammering out final issues with T-Mobile on an agreement aimed at ensuring Dish can become a strong fourth competitor with the US wireless market. Joining us now to discuss, I'm pleased to say it's Michael Wolff, founder of Activate, a technology and media consulting firm based in New York. Wolff, of course, was also formerly a Yahoo board member, president of MTV Networks. You're a man who knows content, you're a man who knows communications. What do you think of the chances of Dish becoming a real competitor here?
I think Dish has, one of the things it has going for it is that Dish has 9 million TV subscribers, and being able to add on another service to those people is going to be rather easy. And if you look, Charlie Ergen, Dish's chairman, he's been basically the Svengali of Spectrum. He's over and over again, he's found ways of using Spectrum. So they're likely to get off to a great start. They're not going to be hampered by all of the stores that Sprint and T-Mobile and Verizon and AT&T have. And I really do think they'll be able to make a go of it.
Interesting. So as and when that deal comes through, so the question mark of 5G, how quickly it can be here. Verizon's already unleashed it in a certain extent here in the United States. I hail from the UK, where 5G's just been announced by the likes of Vodafone just today. So are we, particularly with the interesting note of Huawei and some of the dialing back of tensions there, is 5G front and center now for the United States?
5G is definitely front and center. So there's a lot of people who wondered, is this deal with Sprint and T-Mobile, is that going to take away competition? Actually, it's going to enhance competition because we're going to have three companies who are going to be fighting for 5G. And 5G is likely to light up so many things, from virtual reality to augmented reality to mobile gaming. All of these things are likely to really change the outlook for the sector. Now, what happens with Huawei? Huawei is the leader in 5G technology today, and the administration is now loosening the ban on Huawei, and I think some of that just comes from the recent China negotiations. That's a good thing, but U.S. companies have to develop their own technology.
It's a good thing in terms of embedding Huawei within the 5G infrastructure? Because I've been speaking with the Nokia CEO, for example, and he says, look, it's very easy to switch from Huawei to Nokia, and I'm sure Ericsson would like to give it a go.
I think that Huawei is integral to the American chip companies and so many of the other things. So what's happening now is, at this moment, is Huawei engineers are figuring out how to pull out every American component out of their products. And that just doesn't make sense for us. We want to have a very vibrant chip industry. And at the same time, we want there to be competition for core equipment. We don't want the equipment to be too expensive to stop the wireless operators from rolling out their networks.
Okay, interesting. Let's shift from 5G to another area that perhaps you're seeing evolve, and suddenly a man who knows media. What do you make of the push into sports networks that much more? We've just had, of course, the interesting bidding war as Disney and with its merger, Fox had to spin off some of its regional sports networks. Now we know AT&T is trying to reduce its debt load and doing the same thing. What do you think of the future of regional sports networks here?
So the regional sports networks, Fox was required to divest, actually Disney was required to divest the 21st Century Fox networks. and they sold them for $10.6 billion to Sinclair. And what was interesting about that process is you already saw some interest from tech companies. So Amazon at one point was one of the bidders. One of the networks that was pulled out of that was the Yes Network, which was sold for $3.5 billion to the Yankees, but also Amazon was one of the players in that. So we look more generally, AT&T says it wants to sell its regional sports networks, which are much more limited. They have the Rockets, the Penguins, the Mariners, so they're not nearly as big as the Fox networks, but they're not integral to Warner Media. Warner Media is largely national media. So those networks are likely to be very interesting to companies that are local, like Sinclair, to other regional broadcasters. But when you step back, you see all of the tech companies are now getting into sports more generally. So we've got Amazon, which is doing simulcasting of Thursday Night Football. We've got Twitter, which is doing MLS. We've got Facebook, which is supposedly bidding on international sports rights. We're about to see the tech companies get much more interested in sports. Regional sports networks are likely to be a piece of that.
And maybe the sports teams will be able to cash in all the more. We thank you. Always great to have you on.
Great to be here.
Michael Wolf of Activate. Happy 4th of July. Now, DJI's RoboMaster S1 is the drone maker's first ever ground-based robot. It's a toaster-sized device that people can build at home and turn into a battle bot, complete with lasers, bullets, and loads of AI software. Hello World's Ashley Vance got an exclusive first look at the new product.
This thing right here might as well be the Loch Ness Monster with an iPhone 11, or footage of an alien drinking a milkshake in Area 51. It's a highly guarded secret, and anyone who knows about it or has seen it has been forbidden from admitting that it exists for months. That is, of course, until it made its way here to my kitchen counter, and now to you. Say hello to DJI's latest creation, the RoboMaster S1. You all know DJI. It's the world's largest drone maker, and perhaps China's most popular tech company. People obsess over its products with an Apple fanboy-like lust. And DJI delivers, bringing out one new drone after another. But now DJI has decided to bring its talents to the ground. With the RoboMaster S1, it has built a robot aimed at consumers who want to drive around really fast and then shoot each other with pellets and lasers. Because if there's one thing the world really needed, it's the violence of video games brought to real life. The idea for this new robot started here. It's the annual RoboMasters competition that DJI holds in Shenzhen. College engineering students show up for a couple of weeks and try to destroy each other with a variety of robots. As you can see, it's a lot of fun. The big idea then was to shrink these robots down to little ones that regular people could build and then use in their own battles. This fella here is the lead of the design team who helped bring this device to life.
Can you walk me through some of the different parts?
So this is a video transmitter, and here is the camera, and also the shooter mechanism.
Then you've got the bullets in there?
Yeah, 90% of them are made of water. And when it hits things, it smashes and it disappears. Then on each robot, the lights here indicates the hit point. When you repeat it being hit, the robot will end up being destroyed.
That's the object of the game, is to chase each other around and hit these plates. Is there like a laser?
Yeah, and if you always aim at the center, you should be fine.
Because DJI's founder, Frank Wang, is a cruel, cruel engineer, you cannot just buy a RoboMaster S1 and play with it. No, you must first assemble it by hand and learn things along the way about robotics and coding. Here's a group of youngsters DJI turned into its product testing guinea pigs at something it billed as a summer camp.
This robot is also an educational tool to teach programming language. For example, it can be used as an autonomous driving car, but we don't have built-in functionality for this. Kids have to learn how to program themselves to achieve these functionalities.
The hope is that this will teach kids a few things, get them hooked on robotics, and turn into a worldwide sporting phenomenon of sorts.
We hope that in the future, robotics will become a major sport, like football, basketball. That's our vision for this product.
I'm coming for you.
Oh, you
I
can't
overhit
get
it.
me. Oh.
Still ahead, could this summer's travel trend revolve around electric vehicles? We discuss with Turo CEO Andre Haddad next. This is Bloomberg. So Bloomberg's learned that Samsung has completed a redesign of its Galaxy Fold to fix embarrassing screen failures. The company will debut its marquee smartphone in time for the crucial holiday season. Samsung cancelled the April 26th launch after Bloomberg News and others reported problems with the screen on test versions. As we mentioned earlier, Tesla surprised Wall Street with record second quarter deliveries that beat estimates. It's eased concerns over waning demand for the company's electric car that has pressured shares so far this year. For more reaction, I wanted to get the inside track from Turo CEO Andre Haddad. Turo is a car-sharing marketplace that offers, among others, Teslas. Just how popular is a Tesla, whether it's the X, the S, or the 3, to rent via Turo?
Tesla is very popular on Turo. The 3 models, the S, the X, and the 3 are all 3 in our top 10 most popular vehicles last year. And we just recently looked up the latest. We now have Tesla as a make as the third most popular searched for make on the platform.
Are people making businesses out of this? I know I've done stories on Turo in the past where people gather together high-end cars and actually sort of make this their main money-making scheme. Are people buying Teslas on the proviso that they can help finance it via Turo?
A lot of people are looking at the economics of Turo, which, as you know, is helping people earn money with their car when they're not using it. And they're making, the math work. And so a lot of people who couldn't afford a Tesla are now able to afford one with the earnings that they're making. Last year, the average host made around $600 a month sharing their car on average. Teslas typically would deliver more earnings for the hosts that own a Tesla. So many people are realizing that by sharing their car, 7 to 14 days a month, so a third to half of the time, they can now afford a Tesla and the car can pay for itself.
What other trends are you seeing? So clearly there's a desire to get your hands on a Tesla for the weekend. What about electric vehicles in general? What are people about to be using for this 4th of July break here in America?
So EVs are definitely a big part of this holiday season. July 4th, we are seeing record bookings of EVs. Looking back at the last 12 months, EVs have been growing 50% faster than the entire marketplace, both on the supply side and on the demand side. So we're seeing a lot of people realizing that, Turo is a great place to try an EV before they perhaps want to buy one. They can book it for a weekend. They can book it for an extended test drive in many ways. And so EVs are definitely a big part of July 4th. Another big trend that we're seeing this summer is van life on Turo. We're seeing an explosion of the Vanagons of the world and the Toyota Tacomas with a tent of the world, and all of these amazing vehicles that have been either designed for camping or designed for van life, or have been retrofitted with a lot of extras that our hosts are providing to enable a really unique camping experience.
Okay, you've painted the picture for this weekend. Paint the picture of regulation and how able you are to grow the business at the pace you'd like. Because here in New York, I have to go over the bridge to New Jersey to be able to rent a Turo. How are you dealing with the regulatory scrutiny and the ability to grow the business?
I think we're, unfortunately, we're not yet available in the state of New York, but the state of New York is, unfortunately for you and for all of our New York customers, is an exception. We are operating in all other 49 states. There are some unique insurance-related limitations in the state of New York, and we're working with the right regulators and legislators to hopefully make a change over the next year, maybe even earlier. So we're very hopeful to be able to operate in the state of New York. Elsewhere, everybody's excited about seeing, what this platform can do. I think everyone is realizing that cars are very underutilized. We've got 300 million cars in the United States alone. People are in, sometimes financial difficulties and be able to afford their car. Last year, almost 7 million Americans were behind on their car payments. So a solution like Turo can really be helpful to enable more people to afford cars and to make transportation more accessible. So we're definitely going out and telling that story to legislators, to regulators, and I think most people are very open to encouraging peer-to-peer car sharing. I think we're also very open to regulating peer-to-peer car sharing. We've had many successful sessions this year with many states passing peer-to-peer car sharing regulation that was actually a very positive framework for the growth of our model. So we're very hopeful that more states are going to join that bandwagon.
Andre Haddad, a bandwagon, or whether indeed it's a wagonmobile or whatever van they might be using this weekend. We thank you, Andre Haddad, CEO of Turo. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology, of course, is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. Happy 4th of July to our American viewers. This is Bloomberg.